We are in the final weeks of December, and every year I see wealthy families lose money simply because something small wasn't finished before December 31st. Not a big mistake, just timing. Last week was all about charitable giving. Today we are shifting to the deadlines that determine whether your estate, gifting, and trust strategies actually work. These aren't new rules. They are not complicated. They are the easy-to-miss steps that only matter when the calendar is about to flip. And right now, the clock is running. So let's walk through the deadlines that matter most and what needs to get done before year-end. Let's get into it. If you have an irrevocable life insurance trust, this is the most time-sensitive item on the entire list. ILITs have built-in timelines you simply can't compress. Your trustee has to receive your contribution, send crummy notices, give beneficiaries a real withdrawal window, and only then can they use the money to pay the premium. That entire sequence takes time, and it can be crammed into the last week of December. Here's a common December scenario. A family deposits $50,000 into their ILIT on December 20th. The trustee sends notices the next day, but the beneficiaries are traveling for the holidays. The 30-day window pushes into late January. Meanwhile, the premium is due January 10th. Now they are stuck. Either they pay the premium personally, which breaks the whole structure, or the policy lapses. This happens every year. Families assume the trustee already sent notices, or they forget the 30 to 60-day window, or even worse, they pay the premium directly from personal funds. All of this jeopardize the ILIT. Here's the rule you need to follow. Your ILIT contributions should hit the account by December 15th at the latest. Notices must go out immediately. They must be documented. And the withdrawal window must be real, not symbolic. If you are watching this early in December, you are still on track. But you cannot wait. If you are not sure whether your ILIT has been funded or notices have been sent, call your trustee this week. This absolutely cannot slip into next week. Alright, that's ILITs. Now let's move to the deadline that catches even more families off guard. Your annual exclusion gifts for 2025, that's $19,000 per person or $38,000 per couple with gift splitting, must be completed by December 31st. And this is where many families get into trouble. Most people don't realize that completed means the recipient actually has control of the gift. If you write a check, it has to be cashed by December 31st. If you give stock, the transfer must settle before year-end. Wires must arrive before year-end. And if you are gifting an LLC interest, the documents need to be executed and delivered before the calendar flips. Let me show you how much this matters. If you have 5 kids and 8 grandchildren, you and your spouse can move up to $247,000 out of your estate this year completely tax-free. But even if one gift doesn't settle in time, it gets pushed to 2026. And suddenly, you are managing gifts across 2 tax years instead of 1. December is full of bottlenecks. Brokerage transfers take longer. Banks hold wires. Checks clear slowly. Custodians don't backdate anything. And holiday schedules make timing even tighter. Here's the real example. A family initiated several large stock gifts around December 20th. Everything looked fine. Confirmations came through. Transfers showed as pending. But when December 31st hit, only 2 transfers had settled. The other 2 got pushed into January because of holiday processing delays. Same intent, same gifts, but now they were forced to file gift tax returns for 2 different years, all because of 1 business day. This is why early December is the moment to start if you want your 2025 gifts to count. Waiting until last week of the year is asking for trouble. One more thing. If you are married and doing gift splitting, make sure both spouses sign Form 709. Don't assume it happens automatically. So that's annual exclusion gifts. Now, let me show you a strategy most families don't even know exists. This is one of the most overlooked wealth transfer opportunities. You can make unlimited tax-free gifts completely outside the annual exclusion if you pay tuition directly to a school or medical expenses directly to a provider. Unlimited, no gift tax, no reporting. But there are rules. The payment must be made directly to the institution and it must post by December 31st. Tuition has to be for the current academic period. Medical bills must be owed in 2025. Where families slip up is sending money to the child or grandchild thinking it still qualifies. It doesn't. That turns the transfer into an annual exclusion gift and can trigger a gift tax return. Here are 2 quick examples. If your grandson is at Stanford and tuition is $65,000, you can pay Stanford directly and none of that counts toward your annual exclusion. And you can still give him $19,000 in addition. Same idea with medical bills. If your parent needs a $40,000 surgery, Paying the hospital directly makes that a tax-free transfer. No limits, no reporting. This is one of the cleanest ways to move wealth out of your estate while helping family members who actually need it. But timing matters. Universities and hospitals slow down dramatically in December. I've seen schools take 2 weeks to post a payment in mid-December because their accounting offices are short-staffed. Now, let's shift to education funding, because there is another strategy most families underuse. 529 plans are still one of the fastest ways to move wealth out of your estate. You can contribute $19,000 per year, or you can use the 5-year super funding rule and contribute up to $95,000 at once. The mistake families make is assuming 529 contributions are instant. They are not. Custodians usually take 1 to 3 business days to post contributions, and processing slows down even more in late December, especially for large transfers or money coming from an outside bank. If you wait until the final week of the year, your 2025 contribution may not count for 2025. Now, here's why super funding matters. If you are 68 years old and want to fund a grandchild's college, you can contribute $95,000 per child or $190,000 for a married couple using gift splitting. That money grows tax-free. It reduces your taxable estate immediately, and withdrawals for qualified expenses are tax-free when your grandchild starts school. But timing and paperwork matter. If you are super funding, you need to split the contributions correctly between spouses, document the election on Form 709, and give the custodian enough time to process everything. This is the problem with late December timing. If you initiate 3 529 super funding transfers on December 28th, you are rolling the dice. 2 might clear by December 31st. 1 might not post until January 2nd. Now you are amending gift tax returns because of holiday processing delays. Now, a quick reminder on charitable deadlines. If you are making donor advised fund contributions, most sponsors stop accepting large transfers after December 26th. If you are doing QCDs, your custodian's cutoff is probably December 20th to 24th. Not December 31st. And if you have a private foundation, make sure you've met your 5% distribution requirement. If you missed last week's video on charitable giving, I link it in the description. It walks through all of this step by step, including the new One Big Beautiful Bill Act charitable rules that start in 2026. Okay, let me bring this all together with an action plan for the next few weeks. The point of this video isn't to overwhelm you. It's to help you avoid the common mistakes wealthy families make at the end of the year. This isn't about designing a new strategy. It's about protecting the work you've already done. A few missed deadlines, a few delays, a forgotten notice, and suddenly a gift doesn't count, or a trust isn't funded, or a distribution is penalized. When the clock strikes midnight on December 31st, all of these opportunities reset. You can't go back and fix them in January. Here's your action plan for the next few weeks. Today or tomorrow, check your irrevocable life insurance trust status. If you haven't made your annual contribution, do it now. And confirm that crummy notices will be sent immediately. This week, initiate any annual exclusion gifts. If you are gifting stock, start the transfer today. If you are writing checks, get them in the mail. By December 15th, handle all 529 contributions, especially if you are super funding. And if you are making qualified transfers for tuition or medical bills, get those payments started. Final check by December 20th. Make sure everything is processing correctly. Follow up with custodians. Confirm wire transfers went through. Double check the checks have been cashed. Don't wait until next week. The window is closing and these deadlines don't bend. If you're going through this list and thinking, I'm not sure we handled that correctly, or I don't know if this was completed on time, or I think we forgot something important, reach out. We still have time, but not much. Sometimes a 30-minute conversation can save you stress, taxes, or penalties, and make sure the planning you've done this year actually works the way you intended. I'll drop a link in the description below where you can schedule a complimentary estate clarity meeting. Let's make sure nothing falls through the cracks before December 31st. And if you missed last week's video on year-end charitable giving, make sure you watch that next. 2025 is the last year under the current charitable deduction rules before the One Big Beautiful Bill Act changes everything in 2026.